IRAs and 401ks. I want to show you one more way to make more money off the IRS for your kids. At the end of this discussion, you're going to be going, oh my gosh. All right. If you have an IRA or 401k and you live to be age 90, and if all you do is take the required minimal distributions out once you turn 72, chances are you're still going to have 90% of your IRA still intact. So if you have $1 million IRA today and you're 72 years old, chances are when you die, about $900,000 is still going to be in your IRA. Now, remember, your IRA is always taxable to you as ordinary income. And when you leave your IRA to your kids, is ordinary income to them. It does not get a step up in basis. So this is right out of my book. This is a real case. And if you read my book, chapter 17 is my favorite chapter. I love that chapter. It's just so real. Tim and Susan, they want to transfer their wealth when they're died to their children, free from tax, safe from lawsuits, and safe from creditors and predators. Wow, what a concept. Well, I think everybody wants to do that. Tim passed away. Susan's age 80. They have 4 kids. Susan has a house worth $400,000. They have cash in stock of $400,000. And her and Tim's combined IRA is $800,000. Now then, this is kind of normal, isn't it? People go, well, that's not wealthy people. That's not Warren Buffett. That's like my neighbor. That's like me. So let me show you how a charitable planning tool benefits this family. So let's talk about the kids. One kid, Mike, successful doctor, killing it. Just wonderful job. The daughter, Mary, she didn't marry very well. In fact, when Tim died, he made the comment to Mary, I can't wait for your mom to croak. This way we can go buy a new truck and bass boat. Quote, their son, Ed, is in a rocky third marriage, but he's good with money. He's a good-looking guy, too, isn't he? And then brother Dan. A lot of us have a brother Dan in our family. Not good with money, divorced, looking for work. Mom's concerned that brother Dan, when he receives his inheritance, is going to spend it and blow it and end up having to borrow money from Mike, Mary, and Ed. She's concerned about Dad. So let's take care of Dan too, okay? So the house, when mom dies, gets a step up in basis, no taxes. The cash and stock step up in basis, no tax. The IRA, ordinary income when it goes to the kids. She's got basically a regular estate plan. The Ira Distribution Rule says when mom and dad die, the kids can take it all at once. Or there's this new 10-year rule that says, well, the kids can let the money stay in the IRA for up to 10 years. There's no RMD requirement. They just have to fully take out all of mom's inherited IRA after she dies within 10 years, okay? I don't want to get too technical on these IRAs because we could spend all day with these things. But the deal is this. The IRA is always ordinary taxable income no matter who gets the money. Okay. Understanding the risk. While mom and dad are alive, in this case, just her, nothing changes. Her IRA's 401k stays the same. But when she does die, we've got that 10-year rule, and there's some risk exposure here. The kids have the right to take out their portion of their IRA that mom gave them at any point in time, and they shall take it all out at the end of 10 years. It is all a 1099-R. But let's have some fun with this. Remember that charitable trust thing we talked about a while ago for the sale of the business and the building? So here's the value of the estate, $1.6 million. And we know that the non-IRA assets, the house and the cash, will go to the children, zero tax. And the estate plan says that when Tim and I die, the estate goes in 4 equal distributions to the kids. The IRA, we're going to have it go into a charitable trust after mom and dad die. So it's just sitting here as an empty trust. When mom dies, the $800,000 goes over to the charitable trust. The charitable trust is designed to be a 20-year income payout to the 4 children. Using a very conservative number of 5.3%, we're going to distribute $42,000 divided by 4. So each child is going to get about $10,000, $11,000 and change. And over the course of the next 20 years, we're going to distribute out $896,000 of taxable income to the kids. And here's what's cool about just that strategy alone. The $800,000 is an asset protected concept. In other words, a charitable trust has a high degree of asset protection from judgment creditors and predators. Brother Dan, in year 4 after mom dies, receiving the income stream from the charitable trust, he can't take any money from it. If he gets into divorce, it's not going to be part of the divorce decree. It is a 20-year income stream to the kids, period. And they can be monthly, quarterly, however they want it to be. So we take this $100,000 tax bomb, we put it into this charitable trust that's going to pay to the kids 20 years. And for Mike, the doctor, this is a smart deal too, because it's not a question of will Mike being a lawsuit as a doctor. It's a question is how many lawsuits will Mike be in during the rest of his life? So the last thing we need to give Mike is something that doesn't have some form of creditor protection. I could stop right there and go, this is already fantastic. But what's cool here is at the end of 20 years, after this charitable trust has paid out nearly $900,000 to kids with more tax efficiency here, almost $900,000 goes to her church. When I showed that to Susan, tears were rolling down her cheeks. She couldn't believe that with just a little bit of planning strategy here, we can take the worst taxable asset you can own at death, create an income stream to the kids that has tax efficiency of 20 to 30%, and give her church $900,000 after giving her children nearly $900,000. She couldn't believe it. And through her tears, she kept saying, I wish Tim were here. My favorite chapter, chapter 17 in my book. This is not a multi-million-dollar Warren Buffett strategy. This is a strategy that works for anybody that's got at least $500,000 in qualified money, like a traditional IRA or 401k. This is a strategy where using a charitable trust provides a beautiful income stream to the kids, a beautiful gift to the church. There's nothing severely advanced or complex here. Yeah, you will have to spend a little bit of money on the lawyer to draft this trust and that type of thing, but this blows the doors off of leaving an inherited IRA to a child so that they can take the money out over 10 years at some point. This is a beautiful concept. That's strategy number 3, using a charitable concept now where we are making money off the IRS. Chapter 17 in my book. So the CRUT, Charitable Remainder Unit Trust, CRUT, is irrevocable, degree of asset protection. It's outside of everybody's taxable estate. The CRUT pays out for 20 years with less income tax. Charity gets a big fat gift. The IRS gets less. Susan has peace of mind knowing that her children will remember her and Tim with each distribution. And she loved the fact that, well, Susan, we can set this up where it's direct deposit, and then the money goes straight to your kid's account. And she chose to go quarterly. And she's like, so does that mean every 3 months that my kids get a deposit, they're going to remember me and Tim? Yes, ma'am. I would say that. I mean, think about it. If somebody's having a direct deposit to your account of every 3 months of, say, $3,000, chances are you're going to say, wow, thanks, Mom. Appreciate that $3,000 every 3 months for the next 20 years. And Susan's pleased that the IRAs will be outside of the judgment creditors, divorce, and stuff like that. So there is a degree of creditor protection here that is very important for Mike. For Mary, who's in a bad marriage, this is also good for her because now that income stream will go to her. It's not community property in case she finally gets rid of that idiot. Unfortunately, Ed, his wife filed for divorce today. So that should, and honestly, I'm not in divorce. I've been married 40 years now. So, and then Dan, let's think about Dan real quick. Since Dan is not good with money, probably the smartest thing we can do for Dan from an inheritance estate planning perspective is to give him an income stream to protect him from himself. I know sometimes when we're trying to do estate planning and we're talking to the attorney about our kids and how to transfer wealth in a way that makes sense. And And it's always easy to just say, transfer my estate in equal distributions outright to the kids, and whatever happens, happens. With all four of these children, an outright distribution has risk. In all four of these children, just a little bit of thinking and just a little bit more planning, there is probably advantages to doing something that way versus just an outright distribution, whether taxable or not. It's life. Life happens. So I would say that even in the scenario of doing something a little advanced, it makes sense. Now, while Susan's alive for the rest of her life, nothing changes. Her IRA stays her IRA. She takes her RMDs. Nothing changes. We do want to change the beneficiary form so that when she dies, the IRA goes to the charitable trust, because we want the charitable trust to be the mechanism to give the asset protection and the income stream. Susan can sleep comfortably knowing for the rest of her life that her children have a safety net in the form of an income stream. Her church is going to get a big fat gift, and Tim would be proud of her. When we compare the outright IRA, and I'm using $1 million again because I'm from Alabama, Roll Tide, we have a football team, 2-digit IQ, and yeah, we're going to beat the daylights out of Tennessee this weekend. But here's the deal. If she just lets the IRA, $1 million, go outright to the children, we could be looking at about $450,000 in tax. Ugh. All right, if we do the 10-year stretch rule, this is the new thing that started last year. While the money is in the 10-year stretch rule, you need to make certain your kids don't get in a bankruptcy or judgment. Because here's the scenario. This happened in 2014 in the Clark v. Ramaker case. I wrote about it in my book. Worst case scenario, we have one child that inherits this $1 million. That child ends up in a divorce, bankruptcy, whatever. The child could lose the inherited IRA. Remember, mom's dead, so now the inherited IRA is sitting there in that 10-year rule. And if the child does lose the $1 million as a judgment against his IRA, not only does that child lose the $1 million IRA, but that child out of his pocket has got to pay the tax bill on the $1 million that he never even got in his pocket. This is kind of new. The financial planning industry is struggling with how to explain this. The 2014 Clark v. Ramaker Supreme Court case 9-0 ruling, it was a wake-up call for everybody. If we have the IRA go to the charitable trust using $1 million sample, we're going to pay out nearly $1.1 million to the kids. We're going to save the kids probably $250,000 in income tax over the next 20 years. The wealth gain here is $850 for the kids and $850 for charity. Once again, using a very simple concept, such as a charitable remainder trust, we have been able to save taxes, bless our children with a guaranteed income stream, and do something significant for charity on the back end. Every night, Susan gets to go put her head on her pillow, knowing that a little bit of work has tremendous results for both her family and her charity. I call this engineering social entrepreneurship. Remember, we began this thing with a make money, compulsory tax system. This is what I can keep. This is what I can't keep. What I try to help families and advisors figure out is, okay, we have a requirement to share some of our money with the common good of the nation. By default, we're just taxpayers. Or maybe we can start exploring some of these charitable planning concepts, of which there are many, to do this. I think every one of us know that if we were able to put more money in the hands of the causes that we care about, more good would happen from it. Even our dumbest Congress people, and Lord knows we got a bunch of them, even they realize that when I pay $1 in income tax, less than 27% of my dollar does something for the nation. 73 cents of my dollar disappears in fraud, waste, and abuse, budget deficit payments, and other junk. I give a dollar to a worthy charity, 85 to 95% of that dollar is effectively deployed to solve real problems. Yeah, there's always a bad charity out there, but there's a lot of bad governments out there too. But for those of us who want to do the most good, here's a way that we can do a lot of great things while at the same time benefiting ourselves financially and doing the most good. That's the premise of my book. It's a little over 80 pages. It is written with as little words as possible because I am from Alabama. I try to stay away from big words. I try to use as many stories as possible to help people grab the concepts. I stayed away from a lot of tax code stuff, except in a couple places where I had to say, this is what your attorney does not know. Point out this page. And that's the premise of what we're doing here. So hopefully in the last 52 minutes, I've been able to move your cheese. I've been able to help you look at charitable tax planning as a way to make money versus lose money. I've been able to help you figure out that there are ways to create degrees of asset protection for myself and my children. There are multiple ways that I can do charitable giving right now and for the rest of my life, whether we're dealing with a $100,000 block of stock, a $300,000 piece of real estate, or a $200 million business. Charitable tax planning is a go-to solution that most people don't use because they don't understand that charitable tax planning can be profitable.